Graham. It's great to be here today. And congrats again to you and the entire Sohn team on playing such an important role, in the breakthroughs that we're seeing around pediatric cancer. This intersection of biology and technology, I think, will be one of the great advances for humanity in the years ahead. And Sohn certainly for years has been playing an important role in leading the way. Hey, Bill, how are you?
Good.
Great. I think we're like maybe a half mile apart, but when I look at your screen there, it looks like you're in New York.
A little hazy here in New York.
So let's jump right in with valuations. The NASDAQ's getting creamed again today. Bill, you are certainly a student of the public markets. And I know that you and I have both been fascinated by the impact the Fed has had on multiples, in particular over the last 12 months. Last year, rates went to zero, and we saw an unprecedented run up in growth equity multiples. We started last year, if you just take the growth internet index, at about 27 times forward EBITDA. We ran all the way up to 44 times forward EBITDA. And as of today, we've round tripped all the way back to 27 times forward EBITDA. Zillow went from 100 to 200 back to 100. Peloton 80 to 170 back to 80. Stitch Fix 40 to 105 back to 40. So that's where we sit today. So just, you and I are chatting on the phone. Where are we and where are we going?
Well, it's always been fascinating to me that people take on risk in this kind of slow manner, the old boiled frog metaphor, but they can take risk off much, much more quickly. And I think we've seen that here recently. The notion that interest rates are near zero has been this kind of constant drumbeat, not just this past year, but for the past 5 or 6 years, where interest rates have been lower than we've ever seen them before. And I think that mindset, and that just constantly hearing it from everyone, Warren Buffett all the way, to some momentum investor. And it's just lulled everyone into sleep, into letting multiples expand and expand and expand and expand. I remember one day you and I were talking about Airbnb, and I just did this little study where I looked at Facebook and Google, and they were trading at 6 times revenue. And I said, well, what does Airbnb have to accomplish to earn out this valuation that it has? And, they basically would have to hit every plan for the next 5 or 6 years that's out there and have their margins expand to the 50% EBITDA margin that those two stalwarts have, just to stay even, And yesterday, in preparing for this, I was looking at some of the stocks that are outliers on price to sales, and Lemonade, Unity, and Palantir, which have come in 60%, are still at 20 times over sales, although the numbers are moving underneath me as we speak. So let's talk
about that, because I think that is the critical element for folks today. When multiples and when price is adjusting this fast, the elevator down, as you reference, right? But we're still at the prior peak. So we're still at the prior peak internet multiple pre-COVID. The 8-year average that we calculate is closer to 20 or 21 times. So that's another 25% down from where we started the day. But we heard a lot last year that there was a pull forward in terms of digitization, that internet companies were going to grow at higher rates for longer, that software companies were going to grow at higher rates for longer. So if that's the case, should we trade at higher multiples than before, or are we headed back to the 8-year average of 20 times, which is about another 25% down from here?
Yeah, well, and there's one other element to it, Brad, which is there anything that's going to cause interest rates to move away from where they are today? I would, obviously, Stan Druckenmiller made some strong comments yesterday about his belief in inflation. There's very little, because of the overspend from the government. It seems odd to me that we would end up with massively higher rates. If that happened, if rates were to go up, I think everything you just asked about is off the table, because I think the multiples are going to continue to contract. The other factor that has impacted whether these companies are growing faster, in addition to COVID, is just capital. And so there's been massive amounts of capital pushed into the private market. I think there's been a shift in the venture capital industry towards industries where capital can actually affect speed to market. You look at this announcement on the SPAC yesterday of Better.com. This company was started 5 years ago, and it's now a substantial percentage of the U.S. mortgage market. Those types of markets where you can, use capital as a weapon to come in, can lead to growth. But, who knows what the long-term profitability looks like.
So I just want to come back to this point, because I think every portfolio manager, every growth equity manager out there is trying to figure out, do I delever my portfolio more? Are we getting close to the bottom? Are we going to retrace another 25% on multiples? It's why you see the market churning back and forth. Yesterday, it gaps down at the open, it rips. Today, we're selling off. So we have it seems to me, these two competing notions, Bill. On the one hand, it seems fairly clear that corporate taxes and taxes generally, capital gains rates are going higher. It also, with the 10 years back at 1.6, and we have some inflation fears. So there's some risk that inflation is going to be higher and rates are going higher. So those are both negative for growth multiples. And on the other hand is this idea that because of COVID, right, companies like Zoom or companies like Snowflake are going to grow faster for longer. A, do you believe that companies are going to grow faster for longer? And then B, in that tension, which one do you think wins out?
Yeah, well, I would reframe. Look, I'm a lowly venture capitalist. I'm not a macro person, so I have a hard time having an opinion on the first part of that. On the second part, I would say, look, there are technology trends that are going to lead. You go back to just classically, why do we invest in these categories? There are technology trends that are undeniable. The impact of what has happened with COVID and Zoom is you've brought forward, telecommuting by 5 or 10 years, and it's going to drastically change how the world looks going forward. Regardless of whether COVID's over or not, it's still going to change it because everything's now going to be up in the air, and that's going to create massive trends that people can invest behind. And it's not the only thing. Telehealth has been brought forward. That whole area is going to be changed because of what's been possible. And so I think there's going to be a whole bunch of exciting new categories that are brought up because we've brought people closer together and we've gotten rid of the edge of geography, if you will. And so, yeah, I would tend to lean towards the excited side of that argument around the right place.
As sounds like a good venture capitalist. But let's stick with this theme of distortions caused by low interest rates. So, NFTs, crypto, retail trading, I note that Robinhood and Coinbase are number 1 and number 2 in the App Store. So the equity markets are retracing quickly, but it seems like some of these other stimulus effects, right, have perhaps a lag to them. Are Robinhood and Coinbase being number 1 and number 2 in the App Store, is that a new normal, or is that just lagging reversion and really the impact of the stimulus checks that the government's continuing to send?
Yeah, my fear would be that it's the stimulus checks. And I think that, no one wants to believe that money coming from the government becomes instant hot money, which goes into speculative behavior. But there sure seems to be a lot of signs that that's what's going on. Over half of the revenue that Robinhood has reported is payment for order flow for options. And I doubt there's anyone in the audience that studied any type of historical investment research that would suggest consumers trading options on margin is a way to get rich over the long run. And in fact, I'd say that the history suggests it's the opposite, that it's a way to lose money fast. And so unfortunately, I do worry that it's just a speculative endeavor that's going to burn out fast.
While we're on this and at the risk of running into political, why the hell are we still indebting our kids and sending out stimulus checks to everybody when the markets are terrified of inflation, the pandemic is largely over, and Uber can't find anybody to drive their cars for less than $30 or $40 per hour?
Yeah, it's interesting. The labor shortage is real, and we're feeling that in our companies that have labor forces to them. And then I'm a excited investor in a company called InstaWork, which is helping to shore this up by matching temporary labor with where it's needed. But our phone's ringing off the hook at InstaWork because of this labor shortage. And this was the point that Druckenmiller made yesterday, I think, quite cogently. And I don't know why. I guess it could just be political pressure. I mean, we saw this announcement from Gavin Newsom that he wants to do even more stimulus in California, but it's hard not to think that that's related to the recall election.
You and I could really go down that rabbit hole. Let's stay off that for a moment. Back to Robinhood for a second. The new SEC chief is taking a look at payment for order flow, as you know. It represents a huge portion of Robinhood's revenue. Many countries regulate or ban it. What should Gensler do as it pertains to payment for order flow?
It's interesting. I stumbled across a piece that Citadel had sent to the SEC in 2005 where they argued that it should be illegal because of inherent conflicts of interest. And they did as good a job as anyone that I could see writing it down and listing it out. I think it's, misleading to the consumer. The consumer, when they see free commissions, think they're getting the cheapest bargain possible. But obviously, there's a game afoot inside the system, that's sending money back the other way. And it's one of those things where if you try and explain it, anyone that believes payment for order flow is a good idea, try and put them on a TV screen and have them talk for 5 minutes and then have anyone that listened try and restate what they just said. And it's nearly impossible because it's so complex. And I think it's just super easy to make it go away. The SEC tries to talk about fairness, transparency, in our markets and having them be as elegant as possible. This isn't that.
So we have public multiples that are retreating very quickly, but venture seems to be as strong as ever. Why the disconnect, Bill? Why is early, mid-stage, and late-stage venture rounds, why does it seem to be adjusting to the action in the public markets slower than it normally does, or is it adjusting slower than it normally does?
Historically, it's been highly tied. If the Nasdaq's going up, venture's doing well. If the Nasdaq's going down, venture's doing poorly. And I've found them to be highly correlated. The other thing that public market investors probably aren't aware of, but if you decide that, fintech stocks should trade at 30 times sales, the venture community will create as many of those as you possibly want. So I do think the venture community kind of lags the public markets, if you will. In recent years, there's been so much movement from the public markets into the private markets. Historically, there was some crossover, like we'd take a small piece of our public fund and put it in private. But now, and I think it may be that the public market investors are envious of the venture capital GPLP structure, but they've created new entities, raised separate pools of capital that aren't the exact same fund. And that would, in my mind, tend to delay this tight coupling that might cause quick reactions. There's a massive amount of money that's been put in late stage private. It's highly competitive, and it's been getting more competitive. And so it may take a while for this to play through.
I can't believe they're already giving me the 5-minute warning. If we were live, I would be yelling at Graham that I deserve more time. But what's the most overhyped sector in VC today, Bill?
It just tends to be whatever was working most recently, and because that's where people kind of get lulled into believing that it's always going to be this way. And so, you take a category like SaaS, which has been working, to call it overhyped, it's not like it's something imaginative. It's real. Like everything is real that's happening, but that doesn't mean every single company can trade at 30 times sales. Not all of them have the dynamics of a company like yours, like a Snowflake, where, the net dollar retention is off the hook and the pricing model is perfect relative to usage. Not all of them have that way. And so I think what you may see in that category is a little more discernment going forward.
The most underhyped sector in VC today?
You know what I'd probably comment on in that area is I think over the past 3 or 4 years, mainly because of the power of Google and Facebook, that a lot of people have come to tell themselves that consumers over. And part of what led this huge SaaS wave was people just quit paying attention to it, and we are excited investors in Discord and Nextdoor, which I think are next generation, doing extremely well financially, consumer companies. And so I continue to love the notion of looking where people have given up or aren't looking. And so look, TikTok was born in the same window. So I just think you're way better off being the contrarian around things like this.
You coined the phrase 3 doors to the public markets: traditional bank IPO, which everybody knows how much you love, direct list, and SPACs. When we look at the market share between those, the vast majority, over 80%, is traditional IPO today. When we look at this in 5 years, will SPACs still be around, and will direct lists and SPACs together increase their market share over the next 5 years?
Well, I do have strong points of view on this. I think to the extent that we can effectively integrate raising primary capital with the direct listing, no one would choose a traditional IPO process anymore, because it's gotten perversely worse. In 2020, the average IPO was underpriced by 50%. And one thing that'll happen as the markets contract, because for you to be able to give away $100 to $400 million for free on your IPO, you need a really high market cap. And if multiples are contracting, if it costs you 100 or 200 million to go out, that's going to feel even more painful. And so, I think it'll go away. There will be people that will fight it from a regulatory standpoint. And quite frankly, Brad, they're fighting the SPACs from a regulatory standpoint. So there's a whole bunch of people, many of who might be watching on this call, who participated in the $30 billion of giveaway last year, who don't want to see it go away. And they're able to push on the regulatory front and make that happen. But I think there's rising awareness. Once again, if we want our markets to be elegant, we should be using supply and demand to determine price, to determine allocation. We should open the going public process to all investors, not just the best clients of the investment bank. I think people are coming around to understanding that. But
we have 1 minute. I'm going to do a lightning round. The only answer you can give me is long or short. Bitcoin.
Long.
Dogecoin. Dogecoin.
Short.
Uber.
Long.
Gavin Newsom's recall.
What, like it'll happen? Long.
Texas.
Long.
NFTs.
Short.
Facebook.
Long.
Apple.
Long.
SoftBank's VC strategy.
Short.
Thanks for being with us. Graham, I did it. We're going to turn it back to you guys. Thanks for having us. Thanks for all the incredible work you do at Sohn. Patrick O'Shaughnessy, Bill, just texted me and said I need to step up my studio game. I'm not sure what that means, but I know you did a great job today. So thanks for having us, and we'll talk soon.